Hello guys, and glad to have you on board again today. I wanted to make a quick update, not necessarily following the FOMC stuff. We're going to cover this into the next weekly update. It's more about something that has been in the back of my head for quite some time now. You might be remembering, anyway, the title says it all. We're going to talk about Apple. Because I'm having quite a hard time figuring out what to do with the stock market for the rest of that year, for the next couple of weeks though, because we've got some pretty mixed signals. And when they occur, that generally means there is kind of a backstory problem, and kind of reminded me very closely about Apple. And when I looked at the chart earlier this morning, boy, I kind of was shocked. So we're going to have a look at this. So first of all, wow. Quick reminder, I've showed that one into Twitter because it's essential. The daily chart is now showing volatility alerts, and if you remember that, we've had volatility alerts a lot recently, 4-hour chart time frame, most of these, but now the daily is showing signs of volatility as well. So this is really, really significant. Because that tells us one thing, that the next story is us going there, back to the Bollinger Band with a risk of breaking down, or all-time highs. So this is where we're headed, okay? The volatility alert is generally lasting for 5 to 6, maximum 7 context boxes. And as these context boxes are monthly updated, that means basically full first semester of 2023 is going to be reaching out to one of these two. And it's not going to be an easy task. That mostly says as well that probably the first month of 2023 should be a huge and painful arbitrage of both of those opportunities by trading an ugly range across the moving average until we get to decide whether we go there or there. And like I said, don't be dumb enough to think you know the future. I don't. I just picked the choice, and whether I'll be right or wrong depends entirely on external factors which I have no control upon. So just accept to be proven wrong if you're in the wrong side of the equation, and of course that works for both camps. So that's really this is all about. Okay, the thing is that S&P 500 has definitely mixed signals, even though in the backbone of the higher time frames it definitely looks a lot more bullish than bearish. But this is not an area to buy, okay? So this is an area to lock on some gains. This is exactly what I've done, and let the dust settle until we get to eventually confirmation, which would be retracing up to the volatility, to the third range boundary area, okay? So that would be the backbone scenario, okay? Though the volatility alerts kind of, like I said, alerted me into the fact that, well, I was like, something doesn't look good on the S&P 500. When I look at the short term, I see this ugly, ugly expanded wedge structure saying, okay, we're going to get a shitload of volatility. We've got quarterly expirations today. $4 trillion of derivative are expiring today. So this is going to be a complex day to navigate. Don't be dumb enough to try trading short term today. But this thing still remains even more brutal than that, because when I had a look at Apple, I was like, oh boy, that's not good at all. Okay, so Apple on the daily chart, I'm just going to do very quick analysis in here. This is expert stuff. This is a bubble. Okay, so remember the context of this can be nothing else but a bubble. It's really what this is all about. I mean, just removing prices, you would clearly see that. When you can't even see the range preceding a trend, well, that means something has gone overextended, definitely. The thing is, of course, this could be a normal trend followed by absolutely astonishing benefits from this company, very, very, very successful company and so on, and then turns the crazy shit era. The moment in which I said it's going out of control, it's not going to be pretty, when this thing will terminate, it's going to be a nasty move to the downside. And it's been lasting for now almost 4 to 5 years, and we've gone absolutely through the roof. This is really, really out of any rational standards, and it's gone even worse since the COVID. I mean, just have a quick look at this. Okay, so COVID pandemic, okay, we were trading at $70 for Apple. If you look at all of the other fancy stuff back then, the Amazons and the like, they're all back to the 2019 level, okay? So 2019, have a look at this. Amazon is trading 2019 level. 2019, Apple was trading at $50. I mean, boys, do you realize the difference? Amazon is as well a very successful company in terms of revenue stream. So just really something goes wrong in here. So we've explained all of the nitty-gritty stuff behind that, saying that it might last very long because people can remain absolutely irrational way longer than you'll be solvent, though shorting a bubble isn't an easy task to perform, and you might be proven wrong multiple times before you get it right. But the thing is, we have all the necessary ingredients in here: over speculation, over weighting in indices, and a three key school effect. The first one being that, yeah, Apple was weighting more than 6 to 7% of the S&P 500. It's the leader on all major ETFs, which means basically anyone who was willing to have some sort of passive investment in the market, ETF, or just bulk buying the S&P 500, was necessarily buying Apple. Whether he wanted it or not, it was just in. So Apple was in any buying contract available in the market for passive investment and or any investment vehicle. So that has been pushing demand for Apple. On the other end, there was tremendous revenue growth, meaning that there was still revenue growing. The growth rate was slowing down, which was, in my personal opinion, a big red flag when prices go parabolic like that. But still, the revenue was great. And the third key school effect is that on top of it, Apple is buying back their shares at a tremendous rate. So it's basically they're making profits. The growth rate is slowing down, but the people still keep on expecting growth of revenue in an unsustainable model, which is basically, I mean, Apple is just playing the thief game today. They're just taking money out of someone else's job. So this is really not a sustainable business model. And the day this will end, and we're pretty much nearing it, because I don't know if you've missed the news, but there's been a legal court agreement now. Apple phones are going to have to be allowing other marketplaces to compete against the App Store, which is the end of the game for Apple. Basically, all the big apps will probably shift away from the App Store. Because they've been basically been stolen 30% of their revenue just to reach out Apple users. So this is probably something that is going to start having consequences very shortly. And when it will start to show up on the revenue stream, if it does, like I said, it's a big if, but if it does, it's going to be the end. Just basically this thing will collapse on itself because the three key school effects will have the negative consequences accordingly. Basically, if the revenue goes down, they're going to have to stop buybacking, which means stock buyback is basically the only thing that has been preventing this thing from collapsing already. Though the revenue growth will terminate, it will go immediately from bullish to bearish because the revenue will start to contract right after growing. So it's going to go from growth to contraction. There will be no more buybacks, which is going to accentuate actually the downside effect. And last but not least, the fact that it's going down means that probably people will start selling their S&P 500 shares or their ETF. And that means more selling pressure on Apple because it's the overweighted stock in all of these things. So that's really the negative key school effects, which means, of course, Apple isn't going to die because of this. There's going to be a dead cat bounce very likely and stuff like that, but it's not a guarantee. Remember that crashes don't necessarily dead cat bounce. So that's really where I have my big piece of concern right now. Though I have lots of expert stuff. I'm not going to go into all the details, but for example, in here, the third range boundary align across the same level is where I've piled up most of my Apple short selling positions. Well, if we have acceleration to the downside, and this is what I have here, it's not going to be pretty. Crashes are very violent. Okay, in a sense that, of course, lots of people will say, look, Phil, the Bollinger Band is closed. That means there's going to be a lot of buyers in here. Well, let me tell you, first of all, why it won't be the case. Because, yes, that's an historical level. Everyone saw it. It's a very clear and neat level, but we have a lot of bearish signal accumulating in here. We've already tested that support once, and we failed to go all-time high. It rejected as a fourth aligned third range boundary, which is, on my personal opinion, absolutely the sign of a massive market top being built. Though the thing is that we have huge bearish position built in here, mine, but certainly not the only one. The thing is that lots of bears are in position and they're willing to get blood. We don't just want to push back to support. We know this thing is going to collapse, and in that perspective, this is the risk we take. We might be wrong, but as bears, we want more than just that support. So the bears are not going to buy themselves out of this market. The only buyout we'll have is if we go back there. Yeah, if we go back to my entry prices, I'm going to take those shorts off the table, and Apple will go for another absolutely massive rally. But the thing is that if it does not, don't get me wrong, I'm not going to profit take Apple in here. My profit taking is double down on that thing. I think we're going to go way lower. Crashes generally tend to go at least 4 or 5 standard deviations, meaning that if you think we're going to stop there because there is a rising Bollinger Band, no, it's not going to happen, or at least very limited chance for this to show up. So in my personal opinion, if we go lower, we're going to go all the way down lower for multiple reasons. The first support is on a very, very, very dangerous technical level, which is minus 30%. This is the level in which, generally speaking, people start to go emotional. At minus 30%, things looks odd, like, what the heck is going on? Yeah, there's probably a bit of bad news recently over Apple, but that doesn't necessarily mean this thing will collapse. It's still a good company. They're still selling phones, iPads, whatever. It's true, okay? Though people will try to look for some rational arguments against the downside exuberance. But the thing is, once again, did you even question anything about the upside exuberance before? So it's just, yeah, the opposite forces playing around. Moreover, like we stated, it goes generally that the psychology pushes right down to the next level, which is minus 45 to minus 50%, where most of crashes or speculative collapse tend to reach out. So remember, the crash is a follow-through event. There's a speculative collapse that generally retraces to minus 45 to 50% in general. Turns out that in the case of Apple, that area is where we left the gap open. So there are lots of technicals pointing us out there, though I think this is where we're headed. And of course, if we go out there, then, like I said, this thing weighs 7% of the S&P 500. So it's definitely something. If it goes down that big, then the S&P will suffer volatility. And that's not even accounting the fact that people may start selling their ETFs and S&P 500, which could have collateral damage on the rest of the market. So, like I said, I don't want to play doom and gloom. You know I don't do that. I just kind of want to put a bit of nuance in the market. I'm really concerned about what Apple does look like. I don't say it's going to collapse. All I'm saying is that if it starts to go below that support and if it doesn't show some strength, it's not going to be pretty, because there's going to be an absolute bloodbath below those supports. We're going to seek maximum volatility. Like I said, this is where we got standard deviation 4 and 5. So this is definitely going to look for stupid stuff. It's going to be the falling knife type of thing. But most importantly, that doesn't mean the market will recover out of it. And that's the most dangerous part of it. There is a significant chance that we get a dead cat bounce, meaning that personally, this is where I'll close my shorts. And I'll be the first one to sell that fucking thing again if it rebounces. But the thing is, if it doesn't, because some crashes just don't rebounce, we go there, we stay there flat, and then we keep on pushing. If that's what we do, and if we go straight line back down to $50, where I think we're headed anyway in the long run, that's going to be painful. And that's, in my humble opinion, the only way this market has to turn bearish. In that perspective, I'll be wrong with the S&P 500. There will be contagion, meaning that everyone will start selling their financial assets, no matter which one they are. They were going to start selling their ETFs. All the pension funds in the US will start selling because there are the laws and some things like that. If that happens, then yes, it's going to be a shithole, a definite shithole. But in that perspective, like I said, the market must account for the risk. But betting on the risk is a dangerous stuff. Though, like I said, I've always seen Apple as a cover trade. Like, if something goes wrong, it's going to be about Apple. If Apple doesn't go wrong, then that means the market doesn't go wrong either. So I have to let you guys understand, I'd rather like to be wrong with Apple. To be honest, I'd rather like to take a stop loss on Apple and have the whole market going up, because I'll make more profit that side. On the other hand, I also know that the market could just do well. If Apple crashes and then go dead cat bounce, there is a significant 50% retracement to make. So if the market flushes down Apple in a speculative collapse, like the final explosion, fireworks all across the board, just to, in the end, recover violently, because after the speculative collapse, the rebound is quite solid. It's sustained, it lasts multiple months, and that could be actually the bullish catalyst for the S&P 500. Flushing out Apple, making people scared the shit out of their ETFs and S&P 500 holdings for whatever reason. I don't know. The Oracle of Omaha would turn out to be the stupidest investor of all time because he still has 50% Apple in his portfolio. That could be the kind of stupid narrative that we could see in the following years, in the following month. So I am worried about Apple more than ever because back then, all I had was suspicions. It was overextended rally. It was very speculative. Now I have third range boundary alignments, lots of bullshit, and some technical level aligning perfectly with psychological level. So I know we can get there, to be honest. I know, of course, that these are very rare events. There are no speculative collapse each and every morning. So it can happen. It is more significantly probable than people may think of it. Though that's the reason why I'm recording that video, just not to scare the fuck out of you guys, just to say normally if you've been listening to me for years, you know that Apple is a thing not to have in any portfolio. It's too dangerous stuff. It can go up, yes, there's still upside potential, but like I said, it's only speculative so far. Either it's going to be the speculative collapse or there's going to be another final burst of speculative bullshit pushing the thing into its final stage, in which once again I'll sell into that area as well. It's really this is all about. If Apple goes up again, it's for one last final fireworks explosion. But if it goes down, the same fireworks will play. So like I said, don't buy that thing. Don't sell it. It's way too late to sell Apple. But just be aware that if it goes down, it's not going to be pretty. It's going to make the news flows all across the board. It might eventually have collateral damage effect, but it's not a guaranteed stuff. Most of the other stocks have already taken hard hits for a long time now. Look at the Amazons, we're already back to the 2019 level. Same thing for the Googles and the like. So this is really what this is all about. These stocks can take a beating. I definitely think Google could follow as well with the Apple stuff. But look at that. These levels, the 2019 and 2020 level, we're already there. Apple is pretty much like the last standing still bullshit stock that is pushed by absolutely outrageous narratives. And just like you see, when the revenue stream starts to go down, the price tends to fall very quickly. So I'm pretty much more willing to say Google's volatility boundary might hold way more than the Apple's boundary, because to be honest, Apple is just full of shit. It's built and bought out of narratives and passive investment vehicles. Only if this turns out to be bad, boys, it's not going to be pretty. Like I said, and I think one day, just one of these numbers will go bad and it will terminate Apple forever. So that's what I've always said. I've been proven wrong so many times with Apples. It will take just one time to clear that score. So I say it once again. I think that time might come, though I've already started a long time ago. I'm well settled now. It's a win situation for me either way. Either I'm going to make a nice gain or I'm just going to take no loss. But the thing is that I wanted to share that with you guys. The situation looks not good at all in terms of Apple. It's pretty grim. It can go lower. So if it does, don't be among the stupid ones who will buy that thing. But most importantly, don't be dumb enough to fall for the narrative that Apple's contagion, it's going to crash the entire market and so on. I think Apple could crash just on its own. The rest of the market has crashed already for a long time. Most stocks are already down 80%. Though, don't be stupid to sell the good stocks you have in a portfolio, okay? It's really what this is all about. Apple may fall, and if it does, and that's a big if, it's probably going to fall alone. It's going to take eventually the big names with it, the other Amazons, Microsoft, Google, who might take a hit of 20, 30%, but they've already taken hard hits already. So the risk to the downside on these ones are more limited than it can be for Apple. Apple still haven't fought a single battle to the downside, though it might take just one of those battles, and it can be very violent if you're not prepared for it. So be cool on the S&P 500, because if Apple goes nuts, then the S&P 500 will eventually go nuts again as well, just because of Apple. I mean, 7% of the S&P 500 is Apple. I don't know the real number. I haven't updated for a long time, but it's still staggering. Apple is weighting a lot of S&P 500s. So in that perspective, just don't try to be too technical on the S&P 500. And I think most importantly, that's what could exacerbate the short-term volatility of the S&P 500 before we settle down for next year. Okay, so bear that one in mind. It can go stupid on the S&P 500. It's mostly because of Apple, in my humble honor. Even though I don't know anything about Apple willing to crash or not, all I'm saying is that this is where the risk is. It's very much a professional grade type of trade, though just let the professionals handle this. Don't try to play gods, and therefore take a bit of distance with the market before the end of that year. It can turn to be tricky. Bye, guys.